Welcome to episode 12 of the Hidden History of Money series, where we cover the topic of how the Soviet Union collapsed and why it feels familiar today. What happens when an entire financial system loses credibility? A question that haunts central bankers. When a government defaults, not on its debt, but on the foundational trust that underpins its currency. This isn't about missed bond payments. It's the moment the world loses faith in the very paper a nation print. The fall of the Soviet Union, a geopolitical earthquake, wasn't triggered by war. The fatal blow came from its economic architecture. It was a liquidity event, a terminal diagnosis delivered in slow motion. For a command economy, hard currency was the only key to unlock the global innovation it couldn't produce itself. When that key stopped turning, the entire machine seized, ultimately ending a superpower. Stay till the end and I'll share the three critical macro signals that preceded the Soviet collapse. These aren't just historical footnotes, they are timeless indicators of systemic risk, the faint tremors that signal a coming earthquake. I'll show how sharp investors use them today to rotate out of risk and into safety before a crisis hits. If you're an investor looking to understand macro risk before it hits your portfolio, you're in the right place. Like, share and subscribe to Finance Arcana. We decode the patterns others miss. This is where history meets foresight and portfolios are protected before the herd reacts. Our story begins in the late 1970s. From the outside, the USSR appeared invincible. A sprawling empire with vast resources, a military parading its might through Red Square, and a space program that challenged the West. It projected an image of unshakable, monolithic stability. But this strength was an illusion. The planned economy was notoriously inefficient, unable to feed its people or keep pace with the microchip revolution. To plug these gaps, it needed imports. And to pay for them, it needed hard currency, dollars and Deutschmarks. A staggering 60% of that vital income came from a single source, oil exports. This created a dangerous addiction. The oil boom of the 70s was a powerful drug, masking the system's sickness and postponing reforms. When oil prices soared, Moscow thrived, affording both guns and butter. But when prices fell, the withdrawal was brutal. The state bled cash reserves, exposing the fatal flaw in its design. As the ruble rapidly loses purchasing power, a stark dual currency system emerges, a classic symptom of a failing state. There's the official economy, a facade operating on state-mandated prices where shelves were often bare. And then there's the real economy, a sprawling informal network where hard currencies like the dollar became the only reliable mediums of exchange. This shadow system, born of necessity, operated in plain sight, eroding trust in all official institutions. Investors take note when an economy needs a parallel market to function. It's a red flag for deep systemic risk. Capital is already fleeing, not just through banks, but in suitcases. This is the first tremor before the earthquake. The ruble had become a political symbol, not a viable financial instrument. Its value was dictated by rhetoric, not market fundamentals, a dangerous decoupling that made rational planning impossible. And when the store of value fails, people move their wealth into tangible assets, foreign currency, gold, anything that can outlast the political storm. Gorbachev's reforms, perestroika and glasnost, were too little, too late to fix the structural rot. To plug widening fiscal gaps, state printing accelerated, flooding the economy with worthless paper. This is a textbook path to hyperinflation, seen from Weimar Germany to Zimbabwe. Consequently, while official inflation was low on paper, the reality on the street was soaring food costs and asset prices, a hidden hyperinflation that ravaged household savings. The central bank was trapped. It couldn't hike rates without bankrupting the state's inefficient industries, wholly dependent on cheap credit. It couldn't float the currency without triggering a catastrophic devaluation. It was powerless to stop the leak. And so, as market liquidity completely dried up, the system entered a death spiral. The final collapse wasn't a surprise, it was an inevitability. By 1991, the ruble wasn't just weak, it was a ghost. Hyperinflation had hollowed it out, rendering the state's promise worthless paper. The state's promise backing the currency had dissolved, rendering it worthless. Trust, the invisible bedrock of any monetary system, had completely evaporated. Generations of savings held in rubles vanished. This wasn't just an economic event, it was a societal breakdown. Entire industries collapsed, not from war, but from the silent paralysis of frozen liquidity. A modern economy reverted to barter. Factories couldn't pay workers. Supply chains disintegrated, and a modern economy reverted to barter. What looked like a sudden political collapse was in fact the predictable final stage of financial system decay. Sound familiar? While history doesn't repeat, it often rhymes. Today, major governments are running unsustainable debt-to-GDP ratios, financing massive deficits with newly created money from their central banks. Real inflation felt by households at the grocery store and gas pump consistently outpaces the official CPI figures, which are often skewed by statistical adjustments. In response, we see a quiet exodus. It's a calculated retreat as investors move capital into alternatives they can control: crypto, physical gold, real estate, and even stable offshore currencies. They are seeking a store of value outside a system they no longer fully trust. The Soviet playbook wasn't isolated. It's just the clearest modern case study of what happens when currency confidence dies. Here are 3 signals used by macro hedge funds and smart money to rotate ahead of systemic risk. 1. FX spread divergence track, the gap between official exchange rates and black market rates in frontier/emerging markets. This spread is a real-time barometer of trust. In places like Argentina, this reveals true market sentiment. A widening gap shows that smart capital is paying a premium to flee, signaling a loss of faith long before it becomes headline news. The wider the gap, the faster capital is exiting. 2. Asset class behavior disconnect. Watch for when asset classes tell conflicting stories. For example, when equities rise while bond stress indicators flash red and small business sentiment plummets. Or when raw commodities rise sharply while central banks insist inflation is contained. This divergence means the market is pricing in a reality that the official narrative denies. The market is pricing in a lie. 3. Central bank policy boxed in. This is the endgame. It occurs when a central bank is trapped. They must fight inflation with higher rates, which would crash the debt-laden economy, and yet they are politically forced to fuel inflation with more printing to fund government spending. When a central bank can neither raise rates nor cut spending without severe political fallout, you're watching the pre-collapse trap. Reallocation becomes urgent. The Soviet Union didn't fall overnight. The collapse was a process visible for years to those who knew where to look and understood these signals. Investors who saw the signals and acted, reallocating to hard assets, preserved their wealth. Those who trusted the official narrative lost everything. In this modern age of unprecedented monetary distortion, the lesson is clear. This isn't about fear, it's about prudence. If you're managing capital, you must study history. Watch the flows, not the headlines, and protect your downside before the storm arrives. If this gave you perspective that protects your portfolio, please like, share, and subscribe to Finance Arcana. We translate history into strategy for investors who refuse to be blindsided. Thank you for watching how the Soviet Union collapsed and why it feels familiar today. Stay tuned to our other upcoming episodes of the Hidden History of Money series.